Nobody knows when the next stock market crash is coming or correction. Nobody knows and can accurately predict when this is going to take place, just like no one knew when it was going to happen in 89 during the dot-com bubble or in the housing bubble crash. Nobody knows. All we can do is look at the charts and the technical analysis, use our insights, education that we have on the markets and economics, and make our best assumption on what is going to take place. In this video, I'm going to be talking about my 2025 preview, what I believe to what is to come in 2025. We're going to be looking over economics. We're going to be looking over the current interest rate environment. We're going to be looking over GDP. We're going to be looking over the CPI data, the inflation data, and we're also going to be looking over the PCE, some more inflation data. So we're going to be looking over the economics of the economy in the U.S. And then we're also going to be looking at a monthly and weekly chart of the QQQ, the SPY, and the IWM, which are the ETFs of the NASDAQ 100, the S&P 500, and the Russell 2000. And we are going to try our best to understand where we are going in 2025 and what most likely is to occur in 2025 while keeping an open mind and doing the most important thing that you have to do in the stock market. And that is react to what is taking place. You always want some sort of a game plan going into any new year or any new decade. You always want some sort of a game plan in trying to understand and predict to the best of your ability through the knowledge and data you have what is going to occur in the markets. But make no mistake, the markets is a constant reactionary environment. You are constantly reacting to new data. You are constantly reacting to new charts, technical analysis, insights, news, etc., etc., etc. That is your armor. That is your armor against sitting in the buying at the top of the dot-com bubble and riding it all the way down to the bottom and then selling at the bottom, buying high, selling low. Same thing with the crash Black Friday of 89. Same thing with the housing bubble crash. We are going to try to see and preview 2025 and take all this data and try to understand what's going to happen. But again, make no mistake, I will be following the markets the entire year, and I will be looking for those cracks to form economically, but also in the charts and based on my technical analysis using my strategies, the high five trading strategy and the Williams consolidation box strategy, which I've made videos in the past depicting how to predict markets, how to predict Bitcoin, how to predict stocks movements based on these strategies. And it predicts it continuing. But again, what it's really used for, especially the Williams consolidation box, it's used to let us know when we need to exit early and not late. Because when we exit early, yes, we might have given back some gains or lost a couple percentages, but it's telling us early on that we can get out and basically limit our losses or limit our gains that we give back compared to not knowing to exit here and exiting down here and then being absolutely buried on our trades. Now, the one thing I want to specify before we get into this, I'm going to be talking in open terms economically and about the markets. Just know when we get I want to specify this. When we get stock market crashes, they are a good thing. They are a good thing if you are younger, because when you're younger, you want to have cash on the sidelines so you can buy in at these bottoms. Because if you buy in on these at these bottoms, it's whenever you will get amazing companies like Meta, Google, other Mag 7s, Teslas. You will get amazing companies at extreme discounts. And then those, like the market, over time, as long as they're good companies, like those companies are, over time they will continue higher because their EPS and their revenues will grow. along with the economy, along with the world economy, they will continue higher and keep growing as the decades and years pass, because that is where we are at. The people that are afraid to be in the markets because, oh my God, what if something crazy happens? Blah, blah, blah. Crazy things always happen. Welcome to the world. Crazy things are going to continuously happen as we are alive and on this planet. And the thing about it is, markets will continue higher. Would you rather sit on the sidelines of the markets because you're scared of something crazy happening, or understand that the markets will continue higher so long as the world is in existence and the world is here? The markets will continue higher and higher and higher over time as long as the world is in existence. And if the world is not in existence anymore, money doesn't matter, material items don't matter anymore. The only thing that matters is survival, food, water, essentials. So the people that sit on the sideline because, oh no, well, what if this happens? The markets are going to continue higher in the long run. So what I wanted to specify was trading and investing are two separate entities. Trading is obviously a tool to create wealth in shorter time frames than investing, which is long-term buying, holding, and only selling when your thesis on the company has changed. Trading is shorter term, it can be longer term in time frame, but make no mistake, trading has an endpoint that is already predicted before you get into the trade. Profit targets, like you guys see me always have. Profit targets are where we were taking our profits and then eventually selling out when our strategy goes against us. Long term investing, though, is not that. Long term investing is something like, I believe in Microsoft, Apple, Tesla, um, Nvidia. I believe in them in the long term. I've done my due diligence. I've looked into the companies. I've ran my spreadsheets and my numbers, and I think they're going to get to this revenue amount in this year, and I think I'm going to get, I'm going to beat the market's average return of 8 to 10% per year. I'm going to get, on Nvidia or any of those companies, I'm going to be getting 12% average per year, which I beat the markets, and it's good for long-term wealth. So again, trading, no, not doing that. Trading versus long-term investing are two different things, everybody. Okay? I just want to make that crystal clear. In trading terms, when you see the top, when you see things about when you're reacting to the markets because you see that things are crumbling and we're here of the crash and the crash is going to be much deeper, with trading, you get out right here. You do not wait until down here. You do not DCA in trading. You do not DCA all the way to the bottom in trading. In long-term investing, you stay in your investments as long as your thesis stays the same. You do not panic sell. You do not try to time the market either. You have cash on the sideline. You see it coming. You maybe raise a little bit more cash right here because you see it coming. Maybe trim the positions that are a little frothy and hold what you want to still for the long term. And then you DCA, keep buying on the way down because you don't know when the bottom's going to be, and then you keep buying on the way up, and the next thing you know, all this buying in here is going to reward you very, very handsomely when we're up here and prices are way higher on the investments that you made, or the ETFs, or if you bought the SPY or the QQQ or the IWM, right? If you bought those and you kept DCAing, then it goes higher over time, like I was talking about. You're going to make a lot of money. And that's why crashes are good if you're younger. If you're a little older, be in money markets, make sure you have enough to live off of until and ride out the crash. That's how it is. um so again, yes, trading and long-term investing are different. I get a lot of comments and people getting confused between, my trades and them thinking um they're investments and my investments thinking they're trades. Okay. Some things I'm in both. Some things like Mobileye, I'm in it as a trade 40%, and I'm in it as a long term investment 60%, meaning 60% of it is a long term investment. I don't plan to sell it unless my thesis changes. And 40% of it is slotted out with shares and options to sell at certain profit targets. That's it, guys. That's it. So let's get into the actual preview of 2025. Um, so again, no one can predict when markets are going to crash. Um, we can do is take our best guess at what's going to happen in the next year based on the data that we currently have. And then, like I said, we continue to monitor the data, the charts, the economics. We continue to monitor all of that because we need to stay on the balls of our feet with the markets. We just don't know. What I will say, just to get it out of the way and to be blunt, and we'll get into everything, I believe that we are going to have a crash in 2025. I don't know what's going to cause it. I don't know if I'm going to be right or wrong. I could definitely be wrong. But what I'm going to show you here and what I believe, just to get it right off the bat, I believe we're going to have one last parabolic move, or what a lot of people like to call a blow off top. I believe that we're going to have that one last parabolic move, blow off top in the overall markets before we top out and then head down. Again, I don't know what this topping out is going to look like. Is it going to be housing? Is it going to be, like the .com bubble where AI just gets so frothy? Is it just going to be a flash crash like an 89 based on fear? I don't know. But my gut and everything that the charts are telling me that we're going to get into tells me that every time we're up here with these interest rates and we start to cut, we start cutting, but then during these cutting cycles, we get these massive crashes somewhere in there. Sometimes in 89, it's just a quick flash crash and then we cut quickly. Other times in the .com bubble, we started having these issues in early 2000 with the .com bubble. We started crashing. We were still hiking rates, and then we hit this plateau, and then we started cutting rates rapidly, and then bottomed out, and then continued higher in the overall markets. And that was from 2000 to 2002. And then another time, the housing bubble crash, we were hiking rates and then topped out, held rates steady, and then we had the housing crash start in 2006. The crack started showing over 2006 to 2008 before we had that crash in 2008 in the markets, and that was when interest rates were down here. So I'm showing you this because sometimes we can keep hiking and then have the crash in here as we're hiking or plateauing. Sometimes we can have the crash after we already started cutting interest rates to relieve the markets, right? Because basically, raising interest rates is to combat inflation and cool an overheated economy. And then cutting interest rates is to stimulate economic growth and increase employment and to help, the overall economy just, again, stimulate it. And then, yeah. So, and then sometimes like back here, we could already be in the rate cutting cycle and then we have the crash. So as you see here, we started the crash when we were raising interest rates, then we quickly cut them. Here, we had the crash after we had already raised rates and then cut rates, and then here we had the crash whenever we were in the middle of cutting rates towards the beginning. So again, 3 different crash scenarios, 3 totally different crash timeframes based on when we were cutting rates. One was after we started cutting in the beginning, one was before we start, but one was as we were raising, and then another one was after we had already gotten to basically almost done cutting rates. So you see what I'm saying? We don't know what it's going to be. We don't know when it's going to happen. I'm just saying that we are at this point here. And I'm going to show you in the charts. I believe we are going to have one last parabolic move, one last epic move blow off top in the markets, and then we are going to have some sort of crash because we've been in this bull market for 2 years and it we're getting a little top. We're getting to a top, I believe. Well, let's move further. So, GDP, we really want GDP to be in this, just above 2. We want GDP to grow above 2 per year. Um and that's just where we want to be. Um, we don't want GDP to be down here where you see these circles because that is negative GDP and that is obviously not good. That means our government and our economy is not growing. We want to be above 2 consistently, stay above 2, and then obviously the higher above 2 the better, right? So that one's pretty simple, guys. We're still above 2. We're at 3.1 right now. Kind of been hovering between 2 and 5 the last couple years outside of COVID, when we crashed, flash crashed, and then outside of 2022 when we had the crash, and then we had negative GDP growth, right? So that's where we want to be. And if we start dipping down below 2, that's whenever we could see some major problems and cracks start forming. Next up, we're going to look at the core inflation. So I believe inflation is going to continue down, but here's what I want to show you. So we double topped back here in the 90s in our this is a CPI. So um in our core inflation, right? We topped out here, and this is year over year. We double topped here, and then we continued downward until about 2000 during the housing crisis, or sorry, my bad, the dot-com bubble. We spiked up, had this spike up to here, and then that's whenever obviously you had the crash because you had inflation spiking as well, and then it dropped through. So basically, think of it like um, coming down, and then we had a higher low form or a lower high form, and then continued lower. And then again in 2000, from 2006 to 2008, inflation got crazy again, and then we had to come down. But basically, you see this. We come down and then we pop up. We come down, we pop up. We come down, we pop up. It's in a downtrend, right? So what I'm seeing here is that obviously we just completely skyrocketed on inflation, completely skyrocketed. But we double topped up here and we are on a steady downward trajectory. But, if I'm charting it and I'm looking at past resistance turn into support, we're going to be looking at right around 2.8 that we could hit some support between 2.8 and 2.4, and then even down to another level of 1.6. This is our, support zone essentially for inflation. And the Fed wants it below 2, which is all the way down here. And I believe we'll get there over time, but something that could possibly, I don't know, what could possibly happen is we continue under the 9 EMA, which is also the high 5 trading strategy indicator, and the smoothing line that follows it. And you basically want to stay underneath this, and it'll stay in your downtrend, right? Just like we saw back here, we stay underneath it, up, and then we popped over it. That's not good. Then we stayed underneath it, then we popped back over it. That's not good, right? We want to stay underneath it. But what I can see happening is once we get down in this area and we don't know what it's going to be economically, we've seen it could be the AI bubble, it could be housing again, it could be cracks in the bank, it could be so many things, guys. We don't know. It could be war. We don't know. Don't try to predict what it's going to be because you're going to just hit your head off a wall consistently because you don't know. Nobody knows. But just understand that this could be the cause of it, right? Because we could continue to cut rates and then we could see some economic problems and cracks start to form. And then one big blow off top event happens to basically where we're down here and inflation's down here and we get this spike back up. If we get this spike back up above, if we get below 3 and then we get a spike back up above 3, that's gonna scare everybody. That's gonna freak everybody out, and that's going to most likely cause at least a correction, if not a crash in the markets. Okay. So I'm just spitballing here. This could be that thing. We continue because this inflation went so high, guys. This inflation went to the highest point since the 90s. And we were in a consistent downtrend since then. And then what happened? Boom, big pop, big pop. And now we had a big downturn. And I think, again, we can get down in here and then see a dead cat bounce of some sort, right? Something. Because to get inflation just to go down a straight line, that's wishful thinking. Okay. Again, I don't think we're there yet. And you see, we still have this room. So inflation can continue down, which means markets stay frothy, markets stay happy. Fed keeps cutting because they're sitting there like, oh, we're still good. You know, inflation's coming down. All the numbers are coming in good. And then we hit in this area, though. Cracks start to form. Maybe it's unemployment, maybe, whatever, right? What I said before. It could be anything, housing, it could be unemployment, it could be the AI bubble, things just getting way too frothy when we get that parabolic move and next thing you know, we have 30 PEs in front of Mag 7 names, right? You don't know. You don't know. Stop trying to predict it. I'm just giving you ideas of what it could look like, right? So, I believe we get down in here in this area with inflation. And again, this could be it. This could not be it. Who knows? And then what I could see is maybe a tick back up above three interest rate, or sorry, 3% inflation rate. And that spooks everybody. That spooks the Fed. And the next thing you know, the Fed's not just spreading FUD, fear, uncertainty, and doubt like he did the other day. Now he's actually sitting there and saying, okay, I have to hike interest rates. And if he starts hiking interest rates when we've been going down in interest rates, that's going to freak everybody out. Or what could happen is obviously inflation spikes, but then the overall economy has some big event and big crash or some sort, some big crash of some sort. And then next thing you know, he's not hiking anymore. He realizes, okay, well, we need to, again, it might not be inflation and it might be some big crash. And he sits there and says, okay, inflation's under 3. We need to just cut rates down to 0 or down to 1 or 2 or something like that to stimulate the economy and increase in employment. So it could be inflation, or inflation could keep falling down to here and then not even spike back up. And it could be something else, right? So you see what I mean? You don't know what it's going to be. All we have to do right now is just see, what's happening. Inflation's coming down, but is it just going to come down a straight line, or is it going to come down a straight line to here and then bounce and then cause all this fear, uncertainty, and doubt and so on and so forth, right? Moving on. Our uh, PCE, right, which is the Fed's preferred inflation gauge, it's done really good. Okay. What I mean by that is that this box that we're in right here is where we want to be with PCE. And these outliers are not where we want to be, right? These 3, this one, this big one, and then obviously what was 2020 to um, this year. We do not want to be outside of this box. We want to be tight inside this box and just bouncing back and forth like a crazy person in a room, because that shows us that inflation is staying cool and we are good to go. Okay? That's what we want, and that's why I say we're looking good now, because we're back in this box with still some room to fall down to the bottom here, down to 0. So, with all of these economic numbers over the years and everything, it really just comes back to these are just, GDP, these are just things to look at, inflation, obviously. These are things to look at, but what it really comes down to is we don't know what it's going to be that causes a crash. I just believe that we could see a crash, like I'm going to get into in the QQQ, because we have ran a lot the past 2 years, and we are at all-time high. We are at highs on the current interest rates. And I just have to look back at history, and every time these interest rates have been, spiked up here, we get these massive interest rate flushes down that coincide with some sort of a crash. That's just what history tells us, guys. But again, to sit here and say, well, just because we're up here means we're going to crash right now. Just because we're here, we're not going to crash. Just because we're down here, we're not going to crash. Just because we're raising doesn't mean we're not going to crash, right? So again, I showed you 3 different crashes, 3 different examples where they all crash at different time frames in the cutting cycle. Or sorry, in the interest rate cycle. One was as we were raising interest rates, one was as we were at the beginning of cutting interest rates, and then another one was at the end of our cutting of interest rates. So I think I beat that horse dead enough. Honestly, I think you understand what I'm saying. Nobody can predict this stuff. I just think in my gut and based off of this, right? This is 2022 to 2024, and it could go. 2025 gets to down here, right? And then 2026 is over here. I it's it's right in this ballpark. We didn't get the crash here. I mean, we got to pull a good correction here, but we didn't get a crash. And we just have all this room. And like we saw, it didn't happen in here, so it could happen here or it could happen down here. But those are both in 2025 is what I'm saying. So, let's get into the QQQ on the monthly and then we'll wrap this video up. We're almost done. Um with the QQQ, the Nasdaq 100, we see that back in 2020, we had this massive move up of 151% in the QQQ before we got this massive crash, right? Can we call it a crash? Yes, we can. We can call it a crash. So, we had this massive crash already, and and again, this brings me back to, like, you can spin this data any way you want. We had a 37% crash from 2021 until 2023. So could that have been the market crash that we're all waiting for? It definitely could. And again, this is why I'm trying to tell you, like, yeah, I believe we might have a crash in 2025, but I don't know. We could not. But what I'll show you in the Qs and stuff, you'll see that we are pretty high right now, especially on the channels. But that was right in here, so it kind of coincides with the dot com bubble where we crashed as we were hiking rates. So again, we could already had it, but in my gut and opinion, I don't believe we did. But again, we could have. We don't know. We don't know. So, um, yes. So we had this big move down, and then from there we've ran 114%. So this move was 24,070 bars. This move was 28,000, almost 700 bars so far. Now, what I told you before was I believe that we could have this um parabolic last move, right? Or a blow off top where we run up to our measured move of 580 or even maybe up to 600. I believe we can have that measured move to up here before we have that teetering out topping period and then a crash down to, I would put my dip by crash box to 377 to about 400 area. And that is really because the last time we topped out was right here. And then we also made this support right here when we had this resistance, this support. So basically I would sit here and choose to say, well, if I had to say where we would pull back, it would probably be at the previous resistance points, because like I always say, when you have resistance and you break out of that resistance, you need to come back to retest that said resistance to turn it from resistance into support. Once you confirm and retest this properly and you bounce, now these resistance points just turned into support. Flipping resistance to support is only done by retesting the resistance area, flipping it by bouncing off of it, off the retest, and confirming that it is no longer resistance. We're not bouncing off of it. We're bouncing on it to the high side. Okay. So that's the first thing. But basically, as you can see here, The reason, we had this massive move here, and I basically measured that out, and it's even a bigger move now. And it's been 2 years, and this one it was 2 years before we had the crash. So 2 years crash, 2 years with a bigger move, possible crash, right? But again, before we get that, we'll have the finishing touch on this move with a parabolic blow off top, like we saw in 2020, one, and then you have the move down, in my opinion, right? That's what I'm thinking. And also, I'm thinking that because if we move over here, um, we see this beautiful channel from 2023, right? And essentially, we are getting close to this top of the channel. And like we saw here with the top of the channel, we have a massive pullback down. When we get to this top, we can have a massive pullback down to this area right here, right? And I don't have it drawn on here right now, but a bigger time frame channel, we can basically look at it as such. Do we want to go like that? No, we're gonna go here. See, we're already broken above this channel too. So that's the thing about it is if you want to sit here and say that's the channel, well, the channel has obviously been broken and we're way up past it. You can even if you went up here, right? I mean, either any way you spin it, we're way above it. And when we come up to these previous channels, we reject at the top and then head back down. So that's what I mean. We're just getting a little frothy. We're just getting up there. Like I said, I think we have one more like first quarter, second quarter, first half of 2025 parabolic move up, and then we have that crash. It's looking the same on the SPY, the S&P 500. So we have this move from 2020. We have a bull run from 2020 to 2022. We have a topping period, then we have a massive crash. Um, Crash pullback over about a year time frame, and then we have this second 2-year bull run, right? With this second 2-year bull run where we move all the way up to here. We're approaching that 1 year or 2-year mark. We're approaching that 2-year mark, and it's like, okay, are we gonna have this blow off top up here to the top like we saw with this one? And then we're going, this little blow off top right here. We're gonna have that right here, and then have the crash down to for the SPY. I have it again where previous resistance was coming back down here for a 30+% correction, also to the volume shelf to basically retest prior resistance and flip it into support. And then we bounce higher. Buying the dip down here would be a godsend, and you would make a lot of money in the long run. So, again, they're good for long term investing, but we have to make sure that we're properly tracking this and understanding what's going on based on a trading standpoint. If you're a trader, if you're an investor, you still want to know about this stuff because you want to make sure you have cash for as we continue down. Um, you want to make sure you have cash available to buy on the way down. If you blow all your cash here because you thought it was a short term bounce, then you don't have cash to buy down here. Well, you're not really DCAing on the way down, dollar cost averaging on the way down, and you blew your capital before we even got to the bottom. So you got to take that capital and cash that you have and say, okay, we're in that correction, we're in that crash. I have X amount of capital. I need to divide that out by, I would say, 1 year, because that's typically, especially in recent times, 1 year has been the length of the crash. So you divide it out by 1 year, and you basically say, I'm going to buy that every month on the way down, and then I'm going to buy it every month on the way out before we get back to all time highs. So again, on the SPY, I believe that we have this last little move up to here to about around $650 before we have that bigger overall correction crash. Again, this is just my opinion, just based off what I'm seeing on the economics and based on what I'm seeing on the charts, guys. Um, and then how I properly determine I told you earlier, you need to, have these ideas and understanding and keep an open mind about these things. But what I told you earlier is my strategies are able to help me track and keep engaged with the markets. That way I know when it's happening and when I need to exit. And what I mean by that, we're looking at the monthly chart. We've been looking on the monthly chart for these, by the way. This green line is my high five trading strategy. My high five trading strategy is essentially um, my personal trading strategy that I built that combines indicators with price movement um with candlestick patterns, so on and so forth, right? And it hits for me at about high 70%, win percentage. And essentially, it's really simple. When we're green, we're good, we're rising higher. When we flip to red, it's time to exit. Basically, when we flip to red, it's time to exit because things might be getting a little negative, right? And I couple this with this is the Williams R. This is the Williams percentage range. Williams R percentage is what it's shortened. And basically, what this is, these little boxes here, is my second personal strategy that I couple with my high five trading strategy. And what these I call them the Williams consolidation box. What the Williams consolidation box is essentially you run up to, so right off the bat, you have this red line and you have this green line. Your red line is your barrier and your green line is your support line. And this is because dating all the way back to the existence of whatever stock, whatever market, whatever crypto, whatever, you mark it at the point that it's never gone higher than. It's never gone higher than that its entire existence. It's never gone lower than that its entire existence. Meaning that when it gets there, it's going to reject off of that, like you see time and time again, or consolidate right under it. And that is very useful, as you can probably assume, because knowing when we're going to have a shorter term pullback or a longer term pullback is very important. Now, the way you differentiate and the way I differentiate them with my strategies is a shorter term pullback is just going to be one of those, we're at the top and we come back and then we create support, but then we stay within the Williams consolidation box. We stay within the Williams consolidation box. And essentially, you have your barrier, you have your green support line. Your green support line is your bounce area. Your red barrier is your rejection area. But here's the thing further about my strategy. When you run up above 50, above negative 50 is bullish, below negative 50 is bearish. When you run up above negative 50, what I like to see is a move up into negative 20 and higher. What I really like to see is a move all the way up to the barrier and then a pullback down. Now with the monthly, it's just above negative 30, the pullback. So what you want to see is a run up, a pullback somewhere above negative 30, negative 35, I would say. Somewhere in here. So you have this run up, you have this pullback. Wherever it pulls back to and then bounces, that is now your support. So we ran up, we pulled back. This right here, where this arrow is your support for your Williams consolidation box. Once you have basically your high and your low, you now have created a Williams consolidation box. Now watch what happens. You stay within this box, and as long as you don't break this bottom support, what does the price keep doing? Higher and higher and higher. And you can see it marked by these yellow lines. This is when we started and broke over the 50. This is when we ended and broke out of our supported Williams consolidation box. You see how that works. So as we create a high and then create our low, our support, just like support and resistance on a stock chart, we build our Williams consolidation box. And as long as we stay within this box, we are going to continue higher in the markets. And this is my biggest predicting tool. It couples with my high five trading strategy. Because here's the thing, and here's how you can really predict between a correction or a pullback and a crash. A correction is just going to be you bouncing back and forth between these walls. To go from the high to the low, the Williams consolidation box is going to be a correction. That was a monthly correction. That was a 2-month correction. That was a 1-month correction. That was sorry, that was before. Um, and then these in here, those were small 1-month corrections. So those are pullbacks, right? These are, 5%, 4.66. That's a combination of 5%. So really less than 5 to 6% is going to be a pullback like we see. But whenever you need to worry or really be looking to get out of all of your trades, because when the market pulls back big, when the market corrects or crashes big, you don't want to be in trades to the long side because what's the market doing? It's going down. So when that happens, now trades to the long side, not investments. You're not going to sit there and sell out all your investments. Um, so as you can see with this little circle right here, what do we see happen? We see a break of support, and essentially your Williams consolidation box just went kapooey and broke out to the downside. You basically shattered your Williams consolidation box. When you shatter your Williams consolidation box, things are bad, especially on the higher the time frame, the worse they are. This is on a monthly time frame. We broke out of the Williams consolidation box. At the same time, we flipped to red on the high five indicator. So, right here, right now, what do you think you should have done if you're in a bunch of long-term trades if your Williams consolidation box and your high five indicator turned red? You need to exit everything, because what happened after that? You could have exited here after we had a 5 to 8, a 5 to 8% pullback in the market, but you could have sat there and said, "Oh no, okay, yeah, I may have given back some gains in that 5 to 8%, or I may have, have some losses, but guess what? Those pale in comparison to the actual 30 some percent total pullback, or sorry, 30 some percent total market crash that we actually had." So you tell me, would you rather get out when the market dipped down 5 to 8% and you're still up on, you either break even or still make a little bit of money on all your trades and you save yourself from the bigger downturn? Or, would you rather sell at a massive losses on your trades because they were short term and in what they were built for, a trade, being shorter term to make money, and now you just lost a ton of money and now you're selling at the bottom because it's a trade and you didn't believe it in a long-term investment. So you see how this coupled with this work together to let us know. So whatever I believe in my gut or whatever I'm thinking based on the economics, I could be wrong because I'm just predicting. I'm just making assumptions at what I believe is going to happen based off the data that I have. But make no mistake, I will never act on that gut feeling or that data until my strategies tell me to do so. And then it also works for bottom picking too. So when we come down here, we bounce, we create our resistance this time, and we stay in this Williams consolidation box until we break out. We are going to continue in a downtrend. Once we break out, you see us continue higher. Just to make that clear. So, all of that being said, where are we at right now in the QQQ and the SPY? Well, right now in the QQQ and the SPY, we already went over the years and how far we ran and everything like that. We are still in the Williams consolidation box. You see, we ran up to a high, hit the barrier, came back down and created support. Now, the support didn't come down past negative 20 again. And this support here is all the way down to negative 41. I'll just be honest with you. I'm not comfortable with holding a crash potentially all the way down to negative 40, because what do you see when this hits negative 40? This hits negative 40 here, and that would have been down here, right? So an even bigger crash. So I'm not going to draw the box down to there. I'm going to keep the box, especially we're up here at this tight range. So my pullback area is actually going to be what this last support was back here. I could draw it here, but I'm just going to do it a little bit lower down to here to give me a little bit of buffer room. But anyways, I digress. We have created our Williams consolidation box. And as long as we continue sideways, bouncing up and down like a crazy person in a room, we are going to continue higher. And where do we see it right now? We see it all the way up at negative 8.41 with a high of about 0, let's call it, and a support down to, like I said, negative 22. So we have quite a ways to go down before we would even be looking at a breakout of the box, right? So we could have, a smaller term pullback here, a continued little pullback maybe to this 9 EMA like we saw here to bring us down a little bit more to here to retest that support before we continue higher and go to 650, right? There's so many different outcomes that can happen. But basically what I want to tell you is that overall what I'm going to be doing in 2025 is just simply looking at my Williams consolidation boxes and looking at my high five indicator. If my high five indicator stays green and my Williams consolidation box stays within its confines, I am going to be long in this market on trades. And obviously, I have investments too for long term purposes, but I'm not going to be worried and be selling out of my trades because there's all this FUD and there's all these people, even myself, that's saying 2025 there's going to be a crash. We don't know. I could think anything. I can think anything and I can feel anything in my gut. But at the end of the day, I'm going to be a react. I'm going to react to the markets and what they're telling me based on my strategies. High five indicator strategy, Williams consolidation box strategy. And as we see on the QQQ, it's the same thing. We run up, hit the barrier, we come down, we create our support, we are continuing sideways like a crazy person in a room. And as long as we do that, we will continue up in the markets. And again, on the QQQ, I believe we can go up to, like I said, around 580. Even though we've ran so much, I think we can have a blow off top before we actually come crashing down and break out of the Williams consolidation box. But again, just because I think there might be a crash in 2025 doesn't mean that there will be, right? Again, if we see back in history, we hit a top, we created support, we stayed within this. As we stayed within it, we climbed higher. Then what happened? We broke out. This is on the QQQ, not the SPY anymore. This is the Nasdaq, not the SP 500. We broke out of the Williams consolidation box. We rolled over red on our high five indicator trading strategy. We would have sold out of all of our trades here to prevent this nasty, nasty move down to here and holding on to all our trades as they were just losing and most likely selling out. And then we created a high here, resistance here. We stayed in our Williams consolidation box as we continued lower. Once we broke out of our low five, out of our Williams consolidation box to the downside, once we broke out of that, we flipped to green and we continued higher. It's my strategy is two-pronged strategy, and it's very simple for a reason. It's why I built this indicator, because I just love it in its simplicity of red means bad, green means good, right? Very simplistic. And then you just monitor, you just make a box. You just make a box, and as long as we stay in the box, you're good. And what do we see? Again, we're up here on this one at negative 11, let's say, and we have support all the way down to negative 27. So any pullbacks, down to the 9 EMA and the high five indicator, okay, I'm not worried. Again, once we break out of the Williams consolidation box, once we break this support right here, that's when we're going to get this bigger flush down to, when we do get that crash, it's going to be 400 to 375. And like I said, on the SPY, it's going to be, 460 down to 418. So I think I've talked about all that enough. Final thing I wanted to touch on for 2025 is the IWM. Let's see, the Russell 2000. Whoops. The Russell 2000, it's had this massive pullback down to the cup and handle breakout area. Also, this volume shelf right here. And I think this is where we're going to get that bounce higher. And I think 2025 is going to be a great year for this name. Again, we might get the crash eventually, but until we get that crash, like I said, I think we're going to have a blow off top on the overall markets, QQQ, SPY, and the IWM. We have a blow off top. And what I think is going to happen is the IWM is going to, when we have that blow off top, like we saw back in 2021, I think they're going to have a massive, massive run up. Look, I'll show you. So we had COVID crash, right? And then we had this massive run up to, when was this? 2021. So massive run up. I'm going to change this because I cannot have that. I want it to be blue, blue, blue. So massive run up, right? We're going to copy this. We're going to paste it. We're going to drag it over to this bottom. And look at that. 306. Why is 306 important? 306 is important because you have this massive cup and handle pattern that formed on the weekly. You are currently retesting that cup and handle pattern, have this massive volume shelf that you're sitting on. And what I just said, we're going to have a blow off top, I believe, in 2025 before we have any kind of major crash. If we get a crash, and this measured move from bottom to top is 306. So again, if we're going to have that blow off top in the markets, the IWM is going to have a massive move because it's a smaller market cap overall, right? And assets under management overall. And it's going to have, the biggest blow off top, and it still needs to play catch up to the SPY. If we look over, so if we go over here, let's see, QQQ SPY. What happens before we crash in a bull market, and I've said this a couple of times now, what happens when we crash in a bull market is that, like we saw in 2020, we were down here, and the S&P 500 was down here. The S&P 500 and the Nasdaq ran up here, and the Russell 2000, the IWM, played catch up to get closer because they were so far away. Look how far away we are now. They're so spread out. I believe they run one last time. Maybe the Nasdaq runs a little bit less, and the IWM, the small caps, have the biggest run to kind of play catch up with the Nasdaq and the S&P 500. They play catch up because they all need to tighten up before we have that crash. They tighten up in here before we have that bigger pullback and crash. So typically the end of bull markets are when the small caps really go parabolic and everything gets like crazy because these companies aren't even profitable, blah, blah, blah. They go parabolic, they catch up to the SPY or close to it. And then next thing you know, we crash because things are so frothy and we basically are in a giant bubble. Yeah. The biggest reason for the IWM and the Russell 2000, why I think it's just going to have this massive run up is all those reasons. So this was a beast of a video. Oh my gosh, we're almost at an hour. If you made it to the end of this video, you're a beast. You truly want to learn. And I made a post earlier today, and I was talking about, how not everybody's gonna make it when we have this massive crash. Not everybody's gonna make it. Some people are gonna lose a lot of money, and that sucks. But that's the way of the markets. It is what it is, right? People that are over leveraged, people that are degenerates, degens, extreme gambling, XYZ, or just haven't built that emotional fortitude to not trust their strategies, not trust the process, and basically make sure they're selling. Sorry, let me put this back. To make sure they're selling, when the strategy tells us. When the strategy tells us that we need to sell because a bigger crash is coming, like we've seen in the past, then it's time to sell, and especially on our trades, only on our trades, because we don't want to sit into the bottom of this and then sell down here. Or when we get these crashes, we don't want to panic sell as soon as they happen. If they're just a pullback or just if they're just a pullback compared to an actual crash or big correction. So I made that post, saying not everybody's going to make it. I'm not trying to be a jerk or anything like that. It's just the facts. When we get these big crashes, people people get really scared and they lose a lot of money, and they they say, this isn't for me. I'm just going to go work my job and I'm not doing this anymore. And that's just the circle of life of a trader and the circle of life of the stock market. It will eat you whole. It'll eat you whole and give you nothing. Like that is what the stock market is and can be. It can also be a great tool for generational wealth. You just have to really focus on you and learning, finding or creating a strategy that you are very confident in. Like my high five trading strategy and Williams consolidation box strategy, I'm so confident in it, and I entrust all of my money. I entrust all my money in these strategies, and they've continuously worked over the years for me. So you need something like that, because if you don't have something like that, you just saw, I have a gut feeling, yeah, but you see how I'm going to actually not predict, but how I'm actually going to react when X, Y, or Z happens. Do you have that game plan? Do you have a game plan to what you're going to do when X, Y, or Z happens? Because X, Y, or Z will happen. Wars will happen, assassinations will happen, bad things will happen, global pandemics will happen. These things will continue to happen because that is the world we live in, that is life. And you need to be ready and have a game plan for when those things happen, like I do with my strategies. So that's what I really meant today when I was saying, not everybody's going to make it. You can get mad at me for saying that, or you can prepare to weather the storm. Because the people that have the strategies, that have the cash on the side ready to buy the dip for long-term investing, and the people that get out of their trades before it massively crashes, the people that get out of their trades at 5% down in the overall markets compared to 30% down are the ones that are going to be able to stay in the markets, stay as a profitable traders, stay and keep making money from being a trader. The ones that sell after because they didn't believe it, or they didn't have a strategy to say this is a crash, this is happening, they will be the ones that exit the market because they blew up their account and they have no more money. And now they're going to hate the stock market and never come back. The vicious cycle, guys, vicious. It sucks, but you got to be prepared. Like I said, you got to be prepared for the next housing bubble crash, for the next dot-com bubble crash, for the next crash of 89 and Black Friday. You got to be prepared. You don't have to sit there and worry and not be in trades and not be in long-term investments because you're so worried about the next crash. Oh my gosh. Did I sound worried about a crash? No, I just said I could see one happening. I believe one's going to happen in 2025, but that's just my gut feeling and based off the data that I'm seeing and based off of history. But it might not happen. And guess what? I'm not doing anything based off of my gut or the data that I see now, because none of it is telling me it's happening. Economically, none of it's telling me it's happening with any data. It's just like a gut feeling and what I'm seeing just based off of history. But again, I'm not doing anything until my strategies dictate me to do something. I will not sell out all my trades unless we break this support and break out of the Williams consolidation box and turn red on the high five indicator. If that happens, I'm out of all my trades, got my cash, ready to buy the dip on long-term investments. And now I'm going from uh, buying, trading on an uptrend, trading bullish names, to now shorting, meaning basically trading to the downside, making money on shorting companies to the downside, because now we are in a bear market, not a bull market. So again, if you made it to the end of this video, you're a beast. You truly want to learn. Like I was saying earlier, you want to prepare your emotions. You want to have a strategy. You want to have something to follow for when X, Y, or Z happens in the markets or in the world, because they will. Okay, they will. That's just how it is. So if you made it to the end of the video, you're a beast. And I appreciate you making it to the end of the video. If you know anybody that watched this, I appreciate you all. I appreciate, again, all the support and love across all the social medias that I'm on. I really appreciate it. This was an absolute beast of a video, but I felt like this was a really great preview to 2025 and how I'm feeling in my gut, but how I believe, again, in conclusion, I believe there will be some sort of crash in 2025, but I will not act on that unless my trading strategies tell me. And I'll obviously keep everybody updated on my trading strategies to let you know if I'm seeing that. You'll be the first ones to know. I'll make a big red post and it'll be, yeah. So I appreciate all you guys. I love you all, and I'll catch you in the next one.